Okay.
Good morning, everyone, and welcome to Close More Transactions with SBA Financing. We're not going to be covering just commercial real estate, but we're also going to be covering business acquisition. But I think most of the people who we've been talking to are commercial real estate agents, with a smaller portion being business brokers. But even if you're a commercial real estate agent, a lot of times you'll have an opportunity to work with a business broker where the commercial agent will handle the real estate, the business broker handles the business, and it's a great opportunity to collaborate, and both of you earn more commissions. So today's presentation is brought to you by the Realtors Commercial Alliance of Orange County, where I'm on the board of directors. And we're excited to have everyone with us today. We are going to be recording this for rebroadcast on YouTube. And today we are going to be working with our friend Kelly Chaney. Kelly is here in my upper left corner, in my screen at least. And we welcome him. He's here in Auburn, where I live, at Plumas Bank. And Kelly, go ahead and share your screen. And let's take a look at what some of the slides are that you presented.
Yeah, sounds good, Chris. Thank you. So my name is Kelly Chaney. I'm a Senior Vice President and Business Development Officer at Plumas Bank. I've been with the bank for 15 years and been in SBA Lending. This is my 19th year. So we do business acquisitions, commercial real estate, and I'm happy to be here today. So today's presentation, by no means do I expect anybody that's not already an SBA expert to become one. My plan here is to kind of go through, kind of some entry-level SBA stuff, what's eligible, what's not eligible, but then kind of get into some more in-depth stuff. What is the bank looking for, right? And maybe, some underwriting and credit factors that we look at. And then I've also got a example of a financial analysis to share with you today. Let's kind of dive into what is SBA financing, right? So the acronym stands for the Small Business Administration, right? And this was an independent agency that was created in 1953, right? And the SBA's role is to really aid, counsel, assist small businesses and help them obtain financing that they probably wouldn't be normally eligible for through normal lending channels. And this would be like, primarily commercial real estate, conventional financing, where the focus there is primarily on loan to value of commercial real estate, right? So if most businesses, or some businesses, a lot that we finance, are operating from a leased location and don't own the commercial real estate, and they want to buy or sell business, right? And primarily what we're financing is intangible assets. So what's SBA's role in this, right? So SBA doesn't lend the money, right? The bank does. What SBA does is that if the bank underwrites according to SBA's standard operating procedures, their SOP, which a new one is being released August 1st, with some pretty significant changes that we can talk about later as well. And that document is about, I think it's like 409, 410 pages. So it's pretty in depth. There's a lot that goes into SBA rules and regulations. So, but if the bank underwrites according to those policies, SBA steps in, provides a guarantee, right? And loan amounts of $150,000 or below, that guarantee is 85%. Up and above that, it's a 75% guarantee. So what that does is that basically helps ensure the bank, in most cases, 75% of the loss if a loan does default. So it allows banks like myself, my group, it encourages us to really lend to businesses that are typically deemed a little bit more risky, right? So who's eligible for SBA financing? Well, number one, the business must be organized for a profit. The primary source of repayment for our loans has to be generated from business operations from profit. With nonprofit businesses, obviously that becomes a little bit of a challenge. So the business does have to be organized for a profit. It is a federal program, so the business does need to be located within the United States, and at least 51% owned by U.S. citizen or permanent resident alien. Ironically, we can, if they're a non-permanent resident alien or here on a visa, they can own up to 49% of the business, but a U.S. citizen or permanent resident alien does have to own majority of the business. We're talking about small businesses, right? So they must be small underneath SBA size standards. And that kind of varies and depends dependent upon what industry they're in. Each industry has a different size standard. So take, for example, full service restaurants. Under that NAICS code, the size standard is revenue of $11.5 million or below. Those businesses are eligible. On the opposite side, not that we do a lot of dairy product merchant wholesalers, but this is one industry to where the NAICS code is different, and it's based upon the number of employees, right? So for that NAICS code, those businesses are eligible up to that threshold of 200 employees. There's also, which we use, an alternative size standard, which is actually allows us to lend to, some large businesses, right? So the max under the alternative size standards, which we can use if we have a restaurant that does more than $11.5 million in revenue, it's a max of $15 million in tangible net worth and an average net income not to exceed $5 million in the prior 2 years, right? So I know we're talking about small businesses here, but using these alternative size standards, we could actually start lending to, some larger businesses.
So that's really fascinating, Kelly, because this is new information that I hadn't heard before. And so do you know who it is that sets the NIC standards as far as the sizing for each of the NIC codes?
Well, it's set by SBA. And as far as how they determine that, I think it just boils down to what their definition of a small business is, right? At the end of the day. So the NAICS code, everybody's familiar with that. That's, the North American Industry Classification Code, right? And so each industry has a NAICS code that's not set by SBA, but SBA's definition of a small business is how they determine the threshold.
So I'm kind of curious. Are there sometimes, if the alternate standard of 15 million and 5 million, so does the normal small size standard ever exceed the alternate standard? That's what I'm trying to get to.
No, I haven't seen one because again, you're talking about $15 million in tangible assets, right?
Yeah.
And compared to $11 million in revenue, right? So, and the same thing too is, $5 million in net profit in the prior 2 years. So most of the time, I haven't seen a situation to where the SBA size standard exceeded the alternative size standards. It's generally the opposite.
Okay, cool.
All right. So we talked about some of the standards to make for business to be eligible underneath the SBA. Here are some examples of businesses that are not eligible. And these are the ones that we, run into commonly when we get phone calls from our referral sources or brokers or so, obviously, number one, banks, right? Financial businesses primarily engaged in the business of lending, right? So banks are not eligible, finance companies. The second one here is one that we run into quite often, right? And probably pertains a lot to this group as well, right? So passive businesses owned by developers and landlords that do not actively use or occupy the assets required, right? So meaning commercial real estate. So under the SBA program, when we're financing the purchase of commercial real estate or refinancing commercial real estate, the subject business, number one, needs to be an eligible business, but it has to occupy at least 51% of the total square footage of the property, meaning most of the time it's 4 walls and a roof, right? The improved real estate. So if Chris came to me and said, hey, I've got this great commercial retail strip, it's fully leased out, I want to buy it or have a client that wants to buy it, that's non-owner occupied, that doesn't qualify for SBA financing. But if you take that same example and in the middle of that commercial retail strip is a big grocery store, right? Or gas station, right? And the gas station occupies at least 51% of the square footage of the property, then that's eligible for SBA and they're allowed to lease out the remaining 49%. So, and that's one that we commonly run into and get questions on. This third one is something we ran into quite frequently. It's businesses that are engaged in any illegal activity under federal, state, or local law. And the big one that sticks out on this one is anything engaged in the cultivation or sale of marijuana or marijuana product, right? So there's actually a little bit of a gray area here that, smoke shops might carry paraphernalia that may or may not be used, that can be used, I guess, for marijuana, right? So it kind of gets into this gray area. If we finance them, but if there's certain product in there, it may deem the project ineligible. So anything that's illegal under state, federal, or local law. And then, and this rule, it's always been in effect, but basically anybody that's currently on parole, well, incarcerated, parole, probation, or under indictment for any crime relating to any type of financial misconduct. So it is a federal program. And there's a form that we send out that's a questionnaire early on that asks these questions. So I had one not too long ago to where the gentleman did not disclose that he had a DUI and was currently on probation for that DUI. And since he was on probation, he was ineligible. We didn't find that out until a little bit later on in the process, but that's why we try to get that form out as soon as possible. The last one here, borrowers that have had a prior loss or delinquent federal government debt, right? So I actually had the same exact situation happen. Is that we had a gentleman a number of years ago trying to buy, I think it was a car wash that I think it was 24 years prior, had obtained an SBA loan, had defaulted on that loan, and still had delinquent debt out to the federal government. We found out about that way late into the process. It wasn't disclosed to us. Luckily, he was able to negotiate with the SBA, get that cured, get that paid to a zero balance, and he was no longer delinquent. So we were able to move forward, get SBA's blessing, and close that deal.
I've got a question real quick, Kelly.
Yeah.
Recently, I was talking to a business owner, and they had one of those loans that came out during COVID that needed to be repaid. And apparently something happened. He didn't get the notice, and then he got a notice later that said, hey, you should have made a payment in October of last year. And here it is like May. And so he satisfied that. What kind of an impact would something like that have on current eligibility?
So you're probably talking about is most likely an EIDL.
I'm thinking so. He didn't tell me exactly what the program was, but that's probably what it is.
Well, so if he was late and he's not delinquent now, then he's still eligible, right? And it wasn't a PPP because those were forgiven, so it had to be an EIDL. But and with those is that I think it was interest only or no payments for the first few years, and then all of a sudden it became principal and interest payments. And a lot of people that applied for the EIDL back then are now going through that, right? And so you're not the first person that's called me and said, hey, I was late on my EIDL, but I paid it current. If you did that and you don't have anything, if you're not delinquent now, then you should be eligible for SBA financing.
Perfect.
Okay.
Now, do you know if those payments would reflect on their credit report?
I don't know. So that was provided, those were provided directly from SBA. The banks didn't provide the EIDLs. So I don't know if they reported. I don't think that they did because I haven't seen any clients that I've done recently that have the EIDLs. Actually, I could tell you that we've seen them on the personal credit report. So I don't believe that they did.
Okay, great. Thank you for clarifying that.
Yeah, of course. So what can be financed, right, under the SBA program? And there's and we'll talk about the different types of programs, but as on the whole, the commercial real estate, purchase or refinance a commercial real estate, business assets, right, both tangible and intangible. When you're financing a business acquisition, typically you're financing a cash flow stream, right, the intangible assets, but then also some furniture, fixtures, and equipment, maybe some inventory as well. So financing those is eligible. Partner buyouts, and I'll put an asterisk next to this one because we'll talk about this in a later slide with some of the new changes that are come out with SBA. It provided some pretty significant changes to partner buyouts. So, and we love partner buyouts. I mean, that's one of the best types of transactions that we can get because we know that the management team that was in place before the acquisition is going to be in place afterwards, and we've got an existing partner that's continuing operating the business. Debt refinances, we tend to do quite a bit of those, especially lately. Under the SBA program, and we talked about this a little bit in part one, Chris, is that to do a refinance, not all refinancing is eligible. It has to be on what the SBA is called unreasonable terms, and typically that means a really high interest rate compared to what we would be looking at. A lot of times there needs to be a 10 to 20% increase in cash flow for us to be able to refinance something. But like a balloon payment on a commercial loan or hard money loan is automatically eligible for SBA because it creates a financial hardship for that borrower. So we love debt refinances. Construction, whether that's a ground up or you're doing improvements to an existing property that you own. I right now I've got quite a bit of construction deals kind of going on. So, but that's also tenant improvements, right? So if you're operating from a leased location or you're starting up a new business and you need to do a TI build out, we could do that under the SBA 7A program. And then the last two here, right? Working capital. That's eligible underneath the SBA 7A program, and then finally startups. We don't tend to do a lot of startup. We do several a year. The guidelines are different from a lending perspective between startups and acquisitions of existing businesses, but startups are eligible and we do look at them. Let's talk real quick just about the major differences, and I'll point out a few here of SBA financing versus conventional commercial real estate financing. So the big thing under SBA financing, and what you'll see is that this is typically high leverage lending, right? Where SBA mandates it's the minimum of 10% down when, for most projects, when you're buying commercial real estate, buying a business, purchasing equipment, typically it's a minimum of 10% down, but we could go up to 90% financing. In some cases, we could go up to 100% financing. Right. And so without getting too deep into SBA guidelines, but obviously if we're refinancing debt, we're not going to require typically a down payment into that refinancing. A partner buyout's a perfect example where we could use existing equity that a partner has into the project as the equity into the project and then finance 100% of the buyout. And under some situations, if you're buying a business in the same NAICS code that you're operating now and you have a business, technically, we could treat that as an expansion under SBA guidelines and possibly go up to 100% financing on those. The credit factors permit.
And so the way you're able to go to 100% is because you're using the existing equity in the existing business, correct?
Yeah, I mean, not so much equity. I mean, to a certain degree, yes, but the big thing that we look at, and we'll talk about cash flow and how we look at debt service coverage, is that SBA stipulates that if it's in the same NAICS code, you can treat it as an expansion. So they're expanding that existing business, right? So, but what we look at in those situations is how well that existing business is doing, right? Because we could go up to 90% financing or 100% financing, but if the cash flow metrics don't permit us to, and it doesn't meet our ratios, then the only way to make that happen, obviously, is to put some equity in and get that loan down and get the debt service down. So, but we would look at something like that on a global basis. As well. So,
right. And real quick, while we're talking about the borrower portion, Danny is asking in chat if he can do a cash out refi and use that money that he pulls out of his house as his down payment.
So good question. So under the SBA program, they want to see equity. They don't want to see that the money is borrowed, right? With the exception of if the money is coming from like a home equity line of credit. That is eligible as long as you have outside income outside of the business operations or the business that you're buying to service the debt on that loan, right? So if you do, right, and in a lot of cases it's a W-2, a person that has a W-2 job, right, that's also buying a business and going to be doing both, or if it's a husband and a spouse, and the spouse works and earns income, and she's going to be on the loan, and the husband's going to operate the business, or vice versa. But she's got existing income outside the business to operate. Then yes, that is eligible, and we could use that as equity injection to the project, even though it's technically borrowed, right?
Awesome. So, thank you for clarifying that.
Of course. And then you kind of compare, the kind of the first bullet point here of SBA to commercial financing. Now, keep in mind, I'm not a commercial lender. I've done some commercial loans here on occasion, but typically, right, with conventional commercial financing, it's really based upon loan to value of the commercial property, right? And so in some cases, that's might require 25% down, 30 or 35%, but dependent upon the property type. So again, like I mentioned previously, is that SBA loans are typically higher leverage.
So you mentioned that you don't do conventional. Are you saying that you as an individual banker, or are you saying that your institution?
No, my institution, we have a commercial division. They do. I personally don't. So as far as the guidelines that I'm talking about for what we do, it's based upon SBA.
Perfect. Thank you for clarifying.
Yeah, of course. Um, and then again, with commercial financing, they want hard assets. They typically want commercial real estate, right? So you don't. It's not often that you see a commercial lender lending on a purchase of a commercial real estate and lending on the business assets as well, as far as the intangible assets, right? So you don't typically see acquisition or intangible asset financing there. Personal guarantees, sometimes. I mean, I think there's a lot of commercial banks out there that do require personal guarantees, right, from the borrowers. So with SBA, little to no collateral. I mean, it's oftentimes that we're dealing with basically, acquisition of an existing business, and we don't have any outside collateral, and we're financing 80 to 90% of the project is, goodwill or a liquor license, something intangible. And we've got furniture, fixtures, and equipment, and sometimes inventory as collateral. And maybe the borrower doesn't own a home or doesn't have equity in their home. And so we're doing, a virtually, unsecured business acquisition loan, which is eligible. Right. Then obviously we love business acquisitions. And you can finance intangibles or tangible assets with or without commercial real estate involved in a project. So some pretty significant differences between the two. With SBA loans, so the rules are anybody that has a 20% or more ownership in the business interest has to provide an unlimited personal guarantee, right? And it's not uncommon that you see that, with commercial conventional loans as well, but with SBA, it's mandatory, it's required.
So real quick, talking about the business acquisitions where there's no real estate involved, when they're leasing property, how long of a lease do you have to have compared to the loan term? And what is like
Yeah.
the shortest amount of lease that you would consider to qualify for SBA financing?
Yep, really good question, right? And so typically what we want to see, if the business acquisitions, if you're buying just a business, the maximum loan term per SBA guidelines is 10 years, right? And that's fully amortized over 10 years, no balloon payment. So if we're doing a loan for 10 years, what we want to see is that borrower has the ability to be in that lease space for at least the term of our loan. And whether it's a 10-year term or it's a 5-year term with a 5-year option to renew, that'll get us there, right? Because what we don't want to see is taking a restaurant, for example. We're doing a 10-year term for a restaurant. Landlord gives that, borrower a 5-year term with no options. Well, at the end of 5 years, we still got a significant loan balance, right? And in the event that the borrower has no place to operate, I mean, obviously that's an issue, right?
Mm-hmm.
But there's been some cases to where we've looked at office space, for example, and a landlord said, "Hey, we're only going to give a 7-year or 8-year term, no options to renew," or like a retail storefront space, something small. But in that situation, we've got two options. Number one, we could shorten our term to the term of the lease, right, which affects the cash flow of the business. Or a lot of times what we'll do is we'll kind of look on the different websites, LoopNet, look at around there what's for rent. If there's stuff in the area that's appears to be available, and it's not going to create a huge financial hardship for them to have to move at the end of 8 years, then we can make that credit decision if we're comfortable with the deal and still finance a project over 10 years with a 7 or 8 year term.
Okay, but whatever the term of the loan is, it's always fully amortized over the term of the loan.
Correct. Our loan is, yeah, but the lease, what we love to see is the term of the lease to match the term of our loan, including options to renew, because that's the safest thing. It's the safest thing for us, safest thing for our borrowers as well.
Perfect. And then just real quick, since we're kind of on the subject, if you're financing with real estate, then it typically becomes a 25-year loan amortized over 25 years, correct?
So correct, yeah. So 10 business acquisition carries a maximum 10-year term. Commercial real estate, if we're doing a commercial real estate purchase, it's a 25-year term. There's also a little trick that SBA allows us to use in that if you're buying a business and real estate, If we're financing more real estate in our loan proceeds than we are business, we could actually amortize everything over 25 years. And before this rule went into effect, what we used to have to do, well, and let me back up. If we're not financing more real estate than we are business, then we have to do a blended term, right? And that might end up being like a 17-year term or 16-year term, depending upon how much is business or real estate. So, and that's how it used to be 4 or 5 years ago, I think it was. It was always a weighted average of the loan term. So, I mean, that's a huge benefit for a borrower from a cash flow perspective, because that debt service goes way down because we're amortizing everything, the business over 25 years and the real estate over 25 years. So good question.
Thank you.
So what, as a bank, an SBA lender, what do we look for, right? And every single deal that I do, it's always the same 5 major factors that we look for, right? It's experience, repayment ability, collateral, credit history on the borrower's personal side, but also on the business side, and then capital and equity injection. So let's go real quick. I'll talk about each one here and kind of what I look for and what we're looking for in a borrower. And it boils down to, the main question here. From an experience perspective, does the applicant have the necessary experience to successfully operate the subject business, right? And what are we typically looking for? I mean, we love to see owner operators. We love to see people that have experience owning a business in that industry, right? Before, but we don't always get that, right? Sometimes we get people that have management experience trying to go out there and buy a business within that industry. And we love to see that too. I think typically from a minimum perspective, 2 years of managerial experience in the industry, transferable experience. But again, like I mentioned, we love to prefer to see prior ownership experience, but it's not always, the case. And I put in here license because it's something I wanted to talk about. This coming up a lot, dependent upon the transaction, right? Is if you're running a business that requires a specific license, maybe it's a HVAC business and you have a certain license that you're needed to operate that, right? We really love to see and want to see the borrower have that license, or they have the ability to obtain that license prior to closing, right? So from experience perspective, if you've got a couple years experience in the HVAC business, but not enough to obtain that license, right? That's something that the bank's going to have to look at and assess our risk, right? But if you have an existing HVAC business, right, and you have that license and you're trying to buy out a competitor, that's a completely different scenario. And those are, situations that we love to see. Franchise financing and experience there. It's not always the case that we have experience in the industry, right? And sometimes if you're buying a franchise, say, like a Subway or something to that nature, right? And you don't have experience in the restaurant industry. Sometimes franchise training and the support provided by the franchise may mitigate the lack of industry experience, right? So if you're a contractor now and you're going to go try to buy this multi-million-dollar independent restaurant with no experience in the industry, that's going to be a little bit of a tough sell, right? And the opposite is true. If you're a restaurateur and you have experience in the restaurant industry, but you want to go out there and buy a big construction business and you don't have the license, right, or the experience in the industry, that's going to be a little bit of a tough sell. But that same contractor maybe wants to go buy a small Subway franchise or a franchise opportunity, right? That might be something that we would look at if all the other credit factors that I'm going to talk about here in a second, even though that person doesn't have the experience, right, in the industry that we typically like to see, but they have the support of the franchise, they got the training, they got, that proven support system set up for them. So repayment ability, and this is probably the biggest one that we look at, right? And so the question here, right, is because we get tax returns, we get financial statements on a business acquisition, and we always, the main question here is, do historical tax returns and financials demonstrate the ability to not only service the proposed debt that we're looking to lend, right, but pay an owner a salary, right? And we use a 45% debt to income ratio, and I'll talk about that a little bit later, right? But also generate working capital. So let me just say that again, right? It's three things that we're looking for. Does it service our proposed debt, pay an owner, because nobody wants to work for free, right? And generate working capital. So what we're looking for here, and the tool that we use in our financial analysis is our debt service coverage ratio, right? So the debt service coverage ratio, so take it as an example, debt service coverage ratio of 1.0 is basically means break even, right? The business generates just enough income, profit to service the proposed debt, pay an owner a required salary that they need, but there's no money left over for working capital, right? What we want to see is acceptable debt service coverage ratios, and typically there's not a set factor that we use, but historically a debt service coverage ratio of 1.2 and above or higher is a healthy one because it generates enough working capital, for the business after all the bills are paid. So, but we do a cash flow analysis. We want to see positive trends in revenue, gross profit or gross profit margin, right? And overall profitability. And I use this term based upon lender cash flow because what we get or what we analyze or what we're comfortable with, right? So let me back up. So what we'll end up getting is tax returns and financials from, say, a business broker like yourself, right? And the business broker does their recasting, their add backs, and says, hey, the cash flow is X. And then you talk to the borrower, and the borrower says, yeah, but the cash flow is really Y, right? And a lot of times what you'll see is that add backs that maybe the bank can't prove or the bank can't get comfortable with, right? Vacations, personal expenses, groceries rolled into COGS that are expense through the business used for, the household, stuff like that. Well, we won't give credit to that, right? What we look at and what we've kind of deem it to be lender cash flow. And what that's typically is the net income, and then we add back non-cash expenses like depreciation and amortization, right? Interest expense, officers' compensation, and any, really one-time justifiable expenses, right? Maybe I have one right now, actually, to where you can see on the tax returns that they have a Porsche lease to a very significant expense associated there. Well, this is a business that does not require a Porsche, does not require autos, right? So that's obviously an add back to cash flow because it's the seller's personal car loan that he's doing. So, and I kind of have an asterisk here. This is a rough calculation. It's not always the case because, if an existing business, if we add back the interest, we got to, reduce by any existing debt that they have. So we look at the debt service that they have on their existing debt and compare that to our own as well too, right? So
before you move on, Kelly,
yeah,
talk a little bit about Section 179 expenses, where people will buy a capital asset, maybe up to $200,000, expense it in 1 year. How do you deal with that when you're looking at multi-year financial statements?
Yeah, good question. So that's accelerated depreciation, right? And typically we add it back, right? Here's because depreciation is an add back. So if they have a Section 179 expense and we see it on a tax return and it's outlined, we'll add it back. So, and without getting too in depth into this, though, is that we have to also take a look at, is it this business capital asset intensive, right? Meaning that, let's take an example of a trucking business. Okay. Trucking business that maybe has 10, 20, 30 trucks that are on the road constantly that have wear and tear, right? So we've got repairs and maintenance that we have typically that we see, but we'll also have a lot of depreciation with those trucks. And in those situations is that we have to factor in what's a CapEx, we call it, capital expenditures. They're going to have to replace those trucks. So in situations like that, all the depreciation probably won't be an add back, right? And so sometime we won't add back the depreciation and use that as a capital expenditure, right? But if they're accelerating depreciation, we kind of have to go through and look at their tax returns, kind of look at how often are they replacing those trucks? What are the cost of those? And maybe add back depreciation, but then factor in a CapEx for that. So it depends upon the business. But to answer your question, in most cases, like a restaurant or a gas station or I'm trying to think, even like a CNC machine shop, to where Those assets, we financed a couple. I just closed one. I mean, those have a useful life of 15 to 20 years. But if they're accelerated depreciation, in the first couple of years, then those would be an add back.
So I'm seeing businesses that they tend to make some things that would be considered capital expenses, immediate expenses. Say, for example, you've got a warehouse and they replace the air conditioning unit for the office and they expense it as a repair rather than making a capital expense. Is that something that you would look at as an add
It
back?
is. Yep, it is, because that's, you probably have to replace those once every, I don't know, depending on
15
how you
years
use them.
probably.
Yeah, yeah, or possibly more, right? But yeah,
Yeah.
definitely. It's like you read my mind, man, or you know what's going on in my office right now. I have a deal that I got an interim financial statement on this deal, and uh, there was a lot of repairs and maintenance. I mean, to the tune of a very, very high number, that the profitability went way down the interim. And I said, hey, what happened here? Oh, we replaced this, replaced this, replaced this. I said, well, you guys decided to write them off on the income statement instead of capitalizing them on the balance sheet, right? And so I talked to the CPA, got on the phone with the controller. This was kind of internally what they did for their own books. And so once I talked to the CPA, the controller, they reclassified some of those. And so it actually increased profitability in the interim. But in those situations, what we could have done either way is kind of got an explanation and said, hey, what did you replace? And then use some of those as an add back to cash flow for sure. So, and that's why I say one time justifiable. It's got to make sense at the end of the day.
So, but one of the takeaways that I have from that is if it would have been a filed tax return that they did that, you wouldn't ask them to go back and file an
No.
amended return. You just simply say, hey, give us a written statement of what was on the return and how it was miscategorized, in your opinion.
Exactly. And with an existing business, the luxury that we have is we could go back and get historical tax returns and
Yeah.
depreciation schedules, right? And look and say, hey, listen, this is, and it's something that we can decide to do. There really is, I won't say there's no rule with it, but it's at the end of the day, it's got to make sense and what we're comfortable with. So,
Great. Thanks for answering that and clarifying.
of course. All right. Next factor is collateral, right? And so this is a factor that we pay attention to, but it's probably the least important with SBA because we do have the guarantee, right? So we always analyze the deal and look, what is the collateral coverage, right? Is a loan secured by commercial real estate, or do we have, other assets, like the borrower's personal residence or rental property, right? Not every single deal do we need the borrower's personal residence as collateral, but so what it boils down to is SBA's collateral rule, right? So it basically says the lender must secure all available collateral. Available is the key word here, up to a point where either the loan is fully collateralized, and it's really fully collateralized on a liquidated basis, because anything that's tangible that we take as collateral has a discount factor, right? And we'll talk about that a little bit later, right? So up to a point where the loan is fully collateralized, or there's no more collateral left to pledge. So let's give a real quick example here. Is that if you have a loan request, and let's say it's $500,000, right? And the borrower has a home that has $250,000 in equity in it. And let's just, for the sake of conversation, just I'll leave out the discount factor here. And then has another home that has $350,000 in equity and in a rental property, right? Under SBA's guidelines, right? We would have to look at securing both of those properties as collateral, right? Because they're there, they're available, and we have to secure it up to a point where it's either fully collateralized or there's no more collateral left to pledge, right? Now, take an example. If he had another piece of property, right? Well, we can only collateralize up to the point where we're fully secured. That other property we would not need as collateral. But then also take that same example and let's use a higher loan amount of say 600,000. In the borrower doesn't own a home, or maybe they have a home that doesn't have any equity in it or very little equity in it, right? But we like the borrower, we're fine with all the other credit factors. We can still move forward with that loan and just assess our risk. But we've met SBA's guideline, right? Is that we've taken what's available. There's nothing else left available. And so we can move forward with that one. So, and The reason I changed the loan amount in my example now is that with the new guidelines that SBA is rolling out August 1st, technically loan amounts of $500,000 and below, SBA did away with their collateral rule and put it back on the lender for the lender to make the decision, right? So SBA doesn't, this rule doesn't apply for $500,000 or below as of right now. So
one of the questions I've had multiple times is, hey, Chris, I have my house. I've got a couple $100,000 worth of collateral. I really don't want him to tie up my house. Can I take out a HELOC, home equity line of credit? And how would that impact on the lending decision and the whole process of qualifying my loan?
yeah, that's a really good question, and we ran into that. So to answer your question, the lender could still say, hey, listen, we still want to record a deed of trust on this, right? Because ultimately it boils down to the lender. SBA policy says on $500,000 and more, if the property has less than a 25% equity position, okay, then SBA doesn't require, the lender can basically not take it as collateral. It's the lender's choice, right? So we have had situations where that exact same thing happened, where they took out a line of credit. And there's two things to this too, right? Is if a borrower, and we'll talk about working capital down the road in my example here later on in the presentation, but you know, as a lender, we need to decide, right? Collateral's the last thing that we really are concerned about, right? But if a borrower is taking out that line of credit, having a zero balance on it, it's not necessarily a bad thing for the bank, right? Because now they've got additional working capital to operate this business, right? Because they could draw from the line. And so we could kind of use that as a justification for not taking it, right? But if they're doing that for the sole purposes of skirting the SBA guidelines, you know, at the end of the day, it boils down to risk and what the bank's comfortable with, right? So, but according to SBA policy, SBA won't require that we take it. But the bank could make the prudent lending decision to say, hey, listen, we still want to have this, because at the end of the day, he or she could close that line of credit the next day, and we don't have any collateral, right?
Right. So it really, so much of it boils down to presentation of how is it being presented to you with a rational justification.
Correct.
Now, do you also look at that line of credit and say, well, if they max out the line of credit, here's what their payment's going to be, and here's how it's going to impact on their ability to repay?
Definitely. Yep. Even if it's at a zero balance, what we end up doing is we run, you know, an analysis on, you know, proposed payments, terms, on what typical line of credits are, and we factor that into our debt to income analysis that we do for the borrower to calculate what the borrower needs to live off of. But there have been situations to where I've said to the borrower, hey, listen, we can take your house as collateral, or you can go out there and get a home equity line of credit, right? And I think that sets you up in a much better position. You know, and I'm trying to remember of the last one that I did this on, what type of deal it was, but it was a deal that required working capital, right? And so we were comfortable with that. And when I talked to my credit team, said, hey, here's what we're doing, here's why we're doing it. And we didn't take the house as collateral in that situation, because we actually said, hey, this is on much better terms that we would lend you on working capital, right? And you can go out there and access it in your home, and that worked. So to your point.
And I got a kind of a tag on question to that too.
Yeah.
So you have a homeowner and they don't really have any equity in their house, but they have a piece of investment real estate. And that, you know, a lot of times people will own, especially if they're a new investor, they'll own their first investment real estate in their personal name. But the more sophisticated people will put it into a business entity. And so number one is, will you collateralize the investment property? And does it make a difference on how it's titled?
So it depends. And it depends upon the ownership, right? So basically what we have to look at is that if you apply for an SBA loan, right, we have to look at any affiliate business that you own and what the ownership is. So if you own an LLC and you're 100% owner in that LLC is going to be provide a corporate guarantee for your loan when you're buying this other business, right? So let's say that Chris, you, for example, right, there's a restaurant out there you want to buy.
Yep.
And you want to apply in your personal name. to buy this restaurant, but you have this LLC that you own 100% of, and that LLC owns all your real estate, right? Technically, that real estate is available as collateral because you own 100% of that, right? Now, if you, and say, not a spouse, but an investor partner out there, own 50-50 of that LLC that owns that real estate, then technically it's not available underneath the SBA's guidelines, because that partner has nothing to do with our transaction or your transaction of buying that restaurant. So that's we would not be required to take that property as collateral under that situation.
So when you have a partner in a non-related business opportunity or thing, like we're just saying, what is the percentage of ownership that the other person has to have to disqualify it from collateral?
So really, it's any ownership. It's any
Oh, so
ownership.
they could even be like a minority owner of say 5% or something.
Yeah. So because that person would probably, and I guess it kind of depends upon the what the bylaws say, but if that person, so like if you own a home, right, you and a partner own a home, that partner has to sign up on that deed of trust for us to collateralize that home, right?
Right.
And so probably the same thing with an LLC, unless the majority owner has sign-in authority for everything and can obligate that property as collateral. So, but I mean, you know, typically, can't think of a situation where we've had like a 5% or 1% partner, hold up a deal, to be honest with you. But 20%, 15%, that's probably enough for us to say, hey, that's make a case that it's not eligible as collateral. And that person saying, hey, my partner has signed in authority and they won't sign off on this deed of trust.
Okay. Yeah, I had a question, but it was fleeting. So we'll probably come back to it. All right,
Okay.
so let's move on. Thank you.
All right. So the next factor here, credit, right? And we're talking personal and business here. So let me, probably the easiest way to kind of do this is explain here's what we love to see, right? Clean credit, no past or present derogatory items, right? You're applying for a loan, whether it's a residential loan, home loan, or anything. I mean, this is what lenders to see, right? We love to see FICO scores of 700 plus, right? That's not always the case. And we're more so concerned about what's contained in the credit report than what the score is, right? So history of on-time payments, credit usage, trade lines used appropriately. So here's what we don't love to see. Chronic history of late payments, right? If we go back and we pull credit and there's just multiple late payments dating back for several years, I mean, obviously that's a red flag to the bank, right? So, and even, probably even more of a red flag, recent 30-day late payments. We see those from time to time. If it's, sometimes there's, if there's a recent late payment or prior late payment, and it's one or two items, typically we could get an explanation from the borrower, if it's acceptable, reasonable explanation. Hey, we weren't paying attention, we missed a payment. That's okay. What we don't like to see is that it be chronic history of it, right? Going back for a number of years, and it just seems to be an issue, making payments. So don't love to see charge off or collections. Or prior bankruptcies. If it's something beyond 10 years, typically it doesn't show up in the credit report anymore. So we wouldn't know, other than the fact that on our application, there's a question where you disclose if you've ever filed for bankruptcy, right? And our concern there, really is what was discharged in that bankruptcy. If there's any government debt that was discharged in that bankruptcy, then the borrower could potentially be ineligible for SBA financing, even if it went back prior to 10 years, right? So.
Yeah, and that's really an important point because we ran into that with the project I brought to you recently.
Yep.
Where the borrower had a bankruptcy over 20 years ago, and part of that bankruptcy was discharging an SBA loan. And
Yep.
so when something happens where you have this prior SBA charge off in bankruptcy, what do you do in that situation?
So similar to my example earlier, where we had that person that was buying the car wash that had a prior default on an SBA loan, they got in contact with SBA, and it delayed it delayed our deal for probably, I think it was 30 or 60 days until they worked something out with SBA, got payments made. I mean, at the end of the day, SBA wants us to lend money to these businesses, right? But what we get when we know that there's been a bankruptcy is we get the bankruptcy discharge papers and see everything that was discharged in that BK to see if anything sticks out. Because what we don't want to do is do our normal origination stuff, go through underwriting, order all the reports, spend the borrower's money on credit report or commercial real estate reports, business valuations, single family residence reports, appraisals, and then get all the way to loan docs. And right before we own loan docs, what we do is we submit everything electronically to SBA to issue a loan number. And that's where it kind of goes into a deeper spot of SBA's system to where that they do an eligibility search, and that person may get flagged in their system. And that's what happened to my borrower. We were at docs, right? And we've got a loan number. SBA systems goes back farther than what our system does, and found out there was a loan that was discharged 20 plus years ago. So we put that person in contact with SBA. They worked directly with SBA, got it cured, got it paid, and made themselves eligible again. So in that situation, if there's a bankruptcy and something was discharged, I would advise them to do the same thing, get on the phone with SBA, because there's nothing that we as a lender can do, right? It's got to be cured so that we can get our loan number at the end.
So do you have any idea of how SBA deals with the situation where you had a discharge and bankruptcy 20 years ago? And are they going to negotiate like a lower payback? Do you have any idea about that?
I think they could. I mean, my borrower, the one that I had was the first one in my 19 years in doing SBA financing that, because, that gentleman, for example, could have said, you know what, I don't want to do this anymore. I'm done. I don't want to go back and contact SBA, see if there's penalties, fees, is there issues with IRS, do I owe anything else? It could have opened up a whole, different box for him. He did, and he got it cured. So that was my first one in my 19 years experience where somebody had a prior default that was able to get cured, and we moved forward and closed. So that's, I haven't had any experience other than that, Chris, to be honest with you.
No, well, it's a unique situation, and I've only run across it once myself. And I've got another question too. What do you do, or how do you view people who have high credit limits, say a couple $100,000 on their credit cards, but they pay them off every month and they don't really use their credit cards a lot, so they have a low utilization of their personal credit? How do you view that? Is that a positive or is that a negative?
Yeah, I mean, it's managing trade lines. I mean, kind of, like check mark number 4 underneath, what we love to see, trade lines used appropriately, right? If you've got a high limit on your credit card and your usage is, basically nothing, I mean, that's a good sign for us. And also that raises your credit score, right?
Okay.
So what we factor into and we'll talk about it later in my financial analysis example, is how we calculate credit card debt. We calculate it based upon the outstanding balance.
Okay,
And
good. And there's oh, sorry, go ahead.
yes, and not the limit, the outstanding balance.
Okay, perfect. Now there's a question that came up in chat, and this may be an appropriate time to ask it. And that is, how does an SBA loan affect your personal credit report?
Good question. So if you're borrowing in your individual name, we have to report to your personal, report it to the credit bureaus under your personal name. If you're borrowing underneath a S corporation, it's same thing with a partnership, same thing too, right? So, but partnership or
So you're talking about not a general partnership, but a official filed partnership with like a limited partnership.
Yeah, even a general partnership, because we're lending to that partnership, which is individuals, right? So
okay,
if another entity, LLC, corporation, S corp, and all that, we don't report to the personal.
okay, perfect. Thank you for answering that.
Yeah,
so keep those questions coming in chat, by the way. We're really enjoying those. They add value to this whole conversation.
Now, what I want to say here too is that under this, what we don't love to see, right? I've got something that I put in asterisk here, that are there mitigating factors for weak credit, right? So just because somebody has, one or some of these doesn't necessarily mean that they're ineligible, right? Well, they're not ineligible, but whether, it's whether or not we can entertain the deal or not. And it really boils down to all of these factors that we've discussed so far, right? I've done deals with prior bankruptcies. I've done deals to where we've had bankruptcies that appeared on the credit report, right? That were, 4 years old. I mean, back in 2008 to 2010, during the Great Recession, I mean, a lot of businesses went out of business. A lot of people, were forced to, sometimes file for bankruptcy. And, fast forward to say 2016, where those BKs are still appearing on the personal credit report, but it was tied to, having maybe a restaurant that was just, even like, COVID's a little extreme example, a recent one, but, a business that went out of business because of the Great Recession, and, that it happened. We entertained a deal recently that had a very similar situation. So it's not necessarily that the deal's dead if we have some of these negative factors here, but it just basically boils down to risk and how the other factors look. So
one of the mitigating things might be if someone is in an accident or they had COVID, they were in the hospital and that affected their credit temporarily. But you could see that they've recovered from that.
Correct, absolutely. I mean, sometimes we see medical collections, right? Or illicit collections on there as a negative thing, right? Sometimes there's an explanation for that, too. So it all boils down to risk, common sense, right? But if some of these issues can be explained, they might be acceptable. We might be able to move forward with them.
And we've got a clarifying question up in the chat too. And that is, if you have an S Corp or a single member LLC and it's a disregarded entity, will that, even though you're lending to the disregarded entity, will that show up on the personal credit?
No, it shouldn't, because keep in mind, right, we're still lending to that LLC. That single member LLC designation is how you end up filing your tax return, right? That doesn't affect us. I mean, you can elect to file your tax return, under a Schedule C with a single member disregarded entity, right? Or you can file it under an 1120 as well. So yeah, that shouldn't affect, because we're still lending to the LLC. They're deeming it to be treated from a tax purpose as an individual, which is different from what we look at.
Great.
Right. All right. So our last factor here is capital and equity. And essentially what we're talking about is really, the balance sheet of the borrower, right? Personal assets and liabilities, and then also, the business, right? So we're looking for a minimum, typically 10% down, in just about every single deal that we do, right? Especially for like commercial real estate purchases. Generally, for business acquisitions, even though SBA allows us to go up to 90% financing on a business acquisition, most of the business acquisitions that we see are typically 15% down, right? And obviously, there's mitigating exceptions to this. And that boils down to an acceptable debt service coverage ratio, right? The higher the leverage, the more we're lending, the higher the debt service, right? And when you've got business with a certain amount of cash flow, right, how much we're lending is going to affect that debt service coverage ratio. So we've done business acquisitions with 10% down. Those just made sense. Maybe we had outside income from an affiliate. Not always 15%, but that's typically what we see on business acquisitions. We also look at the pro forma debt to net worth of the subject business. Not really a rule of thumb, but pro forma debt to net worth of 5 to 1 or below is typically what we see, right? And then, I put in here, what does a personal balance sheet of the applicant look like, right? So we have a personal financial statement that we send out, and that discloses all the borrower's personal assets, the debt, right? And if you're looking to buy $1 million business, for example, right? Business acquisition of $1 million, and you've got $20,000 in liquidity sitting on your balance sheet, you're probably not a $1 million SBA borrower, right? And so that's where we kind of look. And then also too, what your net worth is. I mean, it boils down, I've said it many times already, and I hate to repeat myself, but it's common sense, right? We want to see that if you're, for whatever dollar amount that you're looking to borrow, or do you have the capacity, at that threshold? So, and then also what the business balance sheet looks like, right? And then this last one here is something that we really pay a lot of attention to because working capital is so important, right? Is that if you have, 10 to 15% to put into a project, but that's all you have in liquidity, all you have, well, post-acquisition liquidity, you're broke, right? And we don't want to see that. We want to see that you've got reserves, that you've got working capital, right, available to you to operate the business, right? Now, and it really depends upon the type of business. Liquor store, grocery store, gas station, a cash-based business, it probably doesn't need a whole lot of working capital. It needs some, right? You got payroll to make, you got utility bills to pay, you've got product to purchase, right? But that's something different than if you've got, a business where you're buying accounts receivables, right? And you're offering terms to your clients, right? We have to do a working capital analysis to really determine, hey, what's the appropriate amount of working capital that this borrower should have post acquisition. So post acquisition liquidity is something really important that we look for too.
So as part of that post-acquisition liquidity, are you looking for them to have, at least to be able to make the payment for a couple of months if they have a decline in revenue? Is that part of that equation? I mean, because this is probably one of the biggest questions I get from people. It's like, well, I've got the down payment, but how much do I have to have for, working capital and reserves?
Yeah, it's a really good question, and I don't have an exact answer because it really depends upon what they're purchasing, right? The business, so what we do is we look at, and we've heard this from other brokers saying that other lenders say, hey, we want you to have 2 to 3 months of operating expenses. Well, depending upon the type of business, if you're a big construction company that's got, $1 million in annual operating expenses, I mean, that's a huge number of working capital to have that might not be appropriate for that business. So, we go through, we analyze, and we just kind of look at well, and the other thing too is we talk to the borrower, we talk to the seller, and kind of determine what's the appropriate amount of working capital, right, that's needed to operate that business. But it honestly, it varies. It varies from transaction to transaction and business to business, right? So a few months of payments, yeah. I mean, it's not the only thing that we look at. We look at the operating expenses and we kind of, come up with a number that ultimately we're comfortable with as well. And we can lend working capital, right? A part of the SBA 7(a) program is it's eligible for us to lend working capital, and we can do that. And we do that from time to time. What we don't want to do, and I think I mentioned this in part one of what we did, is that if you're putting 10 or 15% into the project, it's not likely that we're going to give you 10 to 15% back in working capital or reimburse you for your injection, right? So we look at your post acquisition liquidity, and we also look at your net investment into the project. So, but to answer your question, and I know it's a circling answer I gave you, it just depends. It really does.
So here's another kind of question that's along those lines. Let's say that you have a business and they're investing in solar panels so that they can reduce their power bill, and the payment on their loan ends up being, say, the same or less than what they're paying the utility company. So even if it's the same, they're looking at rate hikes in the future, and the depreciation and everything as providing a huge benefit. So do you look at that differently when you're seeing a discernible reduce in expenses because of the outlay?
Well, possibly. I mean, but what we don't, we really look at the historical operations of the business and look at the cash flow, right? So, and some deals like business acquisitions, I mean, if you're an existing business looking to purchase solar, we're not going to get projections from you for what you expect to do going forward, right?
Mm-hmm.
If we need that energy use offset to make the deal pencil, it's probably borderline. It might not be strong enough. But if we go through and we analyze the historical operations, right, without it making any adjustments to the utility bills going forward, and the business pencils, yeah, we could slap solar on there, no problem. That seems like a good deal.
And the government has lots of incentives for solar too, so that might help.
Yeah, they do. So I just recently did this on another transaction, and we'll kind of pause here for a little bit, and I'll kind of talk about this really cool scenario that I had. So as I mentioned previously, you're allowed up to $5 million in SBA money. It's not how many loans, it's the threshold. It's $5 million is the max that we can lend to any one borrower. Right. So I had a deal that we did a few years ago for a guy, $5 million that was to build a gas station actually at the time. So he was all maxed out on SBA money, right? He came back to me recently and said, hey, listen, I want to build another gas station. And so he was all maxed out, but and this is actually getting into my next slide here that I have, there's different types of loan programs through the SBA, right? And let's talk about those real quick, and I'll actually incorporate this example in here, right? So the two major loan programs of the SBA are the SBA 7A and the SBA 504. Primarily what we do, 90% of the deals that we do are SBA 7A loans, right? Because we deal a lot with business acquisitions. So under the 7A program, it's the slide 2 or slide 3 that I had with the wheel that had all the different things that we could finance with SBA can be financed underneath the 7A program. It's the universal loan through SBA. Anything that is eligible for SBA can be financed underneath the 7A. So business acquisitions, commercial real estate purchases, debt refinances, partner buyouts, you name it. Mentioned earlier, up to 10-year term on business acquisitions. That's the maximum allowable under SBA rules. And then 25 years for commercial real estate. And we kind of, I guess, got a little bit ahead of ourselves, Chris, but we talked about the blending of the terms there too. So, so the other program is the SBA 504 program. And basically that's for commercial real estate or heavy equipment. And when we talk heavy equipment, it's pieces of equipment that have economic life of 15 years or more, and maybe 20 years is probably more appropriate, right? But business acquisitions not eligible, working capital not eligible. It's basically the purchase or refinance of commercial real estate and heavy equipment. Let me see. And so this program, without getting too confusing, it's structured typically as a 50-40-10. So what I mean by that is, me as a bank, I generally do a conventional loan, commercial loan for 50% of the project. A certified development company, a CDC, comes in and basically does the SBA second for typically 40% of the loan, and the borrower comes in with 10% down. Sometimes that's structured as a 50-35-15, but that's the gist of the program, is that there's a first conventional loan, a second SBA loan. And so for the example that I started to talk about, is that under the 504 program, there's something called the Green Initiative. And what I used that for recently was, under the Green Initiative, if you're, typically like adding solar to a project, commercial real estate, and that's solar, I think the threshold is 15%. If you offset 15% of the energy usage by adding the solar on there, then all of a sudden you can get another $5 million in SBA money. And so this borrower came to me with this new construction project. He was already maxed out on SBA. And I went through the analysis and I said, hey, listen, if you put solar on this and you have this offset, we could put this underneath this Green Initiative, which we weren't too terribly familiar about at the time, but we kind of did some research and talked to the CDC and structured it to where it made sense and worked. And so he did. He went to a solar company. There's a couple different reports that we had to get to kind of make sure that it offset enough to get underneath the Green Initiative. But this gentleman, he's got $10 million in SBA money, right? And then if he adds another one, if he does the same thing down the road, he can get another $5 million in SBA money. So really cool trick that we use. But yeah, there's a lot more to the Green Initiative that I'm not familiar with. Is to use to, go green and, but the solar example is one thing that we used. So
you said something interesting. You said he's got his 5 million from his traditional SBA lending. He then added solar to the new gas station bill so that reduces his energy or offsets it by 15% or more. So that qualifies the entire project for another 5 million.
Yep.
And you said, but he can even do a third project to get another 5 million to go up to 15 million. Did I hear that correctly?
That's correct. And that's what we were informed by the CDC. Because keep in mind, we don't do a lot of 504s. We do some, but most of the ones that we're doing is just purchase of commercial real estate. This was a unique situation to where we kind of dived into an area that we weren't too familiar with. But yeah, according to the CDC, is that if he wanted, he could do the green initiative again on another project and get another 5 million. And that deal that we're doing, I mean, we're doing a $9 million first conventional loan. And then the second, the SBA component is 5 million bucks. So
Wow.
it's a large project.
So now if you have an existing $5 million project, and then you want to expand that same project and include green energy offset, could that one project go up to 10 million?
So another $5 million in financing, not obtain another $10 million is what you're saying, right?
Yeah. So it'd be a
Yeah.
total of 10 million, 5 million existing. They want to expand the same project. So it'd be the same APN, and they're adding the green component to their expansion. Could they have $10 million in financing on that one parcel of real estate that's improved with the green?
Yeah, I believe you can, right? Because again, as long as it's underneath the SBA 504 program, it's not used for the 7A. The green initiative is not for the 7A, but it's for the 504.
Got it. That's very interesting. And I think we're going to see a lot more creative things with green energy as the government is emphasizing that.
I agree. I agree. All right, let's see where we're at here. So let's talk about, because I get this question a lot, right? Is what fees do we typically see with SBA loans? So what we charge as a bank, I mean, typically, there's a bank packaging fee that just about every lender in the nation charges, and that ranges from $1,500. The max that we can charge is $2,500. We charge $1,500. So whether that's $100,000 loan or a $5 million loan, right? The bank fee is $1,500. The biggest fee that you're going to see is the SBA guarantee fee, and because there are changes that are happening, the SBA fees are actually going to change after the end of this fiscal year, which ends September 30th. So that should be October 1st. If everything, there's a lot of talk of more changes coming out. So that's why I'm kind of careful here. But currently, loan amount $0 to $500,000, there is no SBA guarantee fee. Then as you kind of jump up into the next tier, 500 to 700,000, it's 0.55% of the guaranteed amount, right? So typically, well, on loan amounts of $500,000 or more, you get a 75% guarantee. So it's not 0.55% of the loan, it's 0.55% of the guaranteed portion. Next tier here is 1.5% of the guaranteed portion, and that's 1.05% of the guaranteed portion. That's for loans between 700,000 and $1 million. And then the biggest jump you're going to see is that loan amounts $1 million to $500,000. It's actually 3.5% of that guaranteed portion, which again is 75% of the loan. And then it's plus an additional 1/4 point for the amount above 100,000. So, I mean, the quick and dirty calculation on this is that if you're doing a $5 million SBA 7A loan, I think the SBA guarantee fee comes to be about $138,500, right? So there's a big jump, obviously. $0 to $500,000, there's no fees, right? And that will last up until the end of September unless something changes. So, but
So
then go ahead.
The bank packaging fee,
Yep.
there's no such thing as a free lunch. And so how does the bank make money and pay your salary off of $1,500? That doesn't pencil.
Yeah, so good question. And I've been with the bank for 15 years. So historically, these loans have been variable rate loans. Okay, that was pretty much the nature of the SBA 7A program, and still, I mean, I think that's majority of what you see. Behind the scenes, right? If we've got a loan with a floating rate with a 75% guaranteed by the SBA, that 75% can be sold on the secondary market for a premium, right? So our division operated under the business model of basically we're going to sell everything that we can on Wall Street afterwards, right? Earn a premium, Wall Street buys 75%, we retain 25% on our portfolio. That earns interest income, right? But we're able to, by selling that off of Wall Street, we're able to get our 75% back plus a premium and lend that money out 3 or 4 different times. right? So it's profitable, and that's one way to do it. What we started to do January of this year, we actually came out with a fully fixed product, SBA 7A loans, basically. And you'll see on 504, they're pretty much they're fixed in nature. But the SBA 7A loan, we're offering 10-year fixed loans or rates on business acquisitions, fully amortized, fixed for the life of loan, and now 25-year fixed, right? So what we've done over the course of the last 15 years is built up a nice portfolio, right? So our portfolio earns interest income. And then these loans that we're doing now, and who knows how long we're going to be offering fixed rates, might be 12 months, might be 24 months. I mean, just yesterday, Fed got together and increased prime by another quarter of a point. Right? So prime is 8.5 today, right? So, but to answer your question, I mean, it's basically servicing income on our existing portfolio, interest income on our existing portfolio, and then earning interest income on these fixed rates that we're doing now. So, did that answer your question?
Absolutely. But I know that's a question that I've been asked multiple times.
Yeah. So, other fees, right? Acquisition of an existing business. As of right now, if the loan amounts above $250,000, SBA requires a third-party business valuation to be done by a licensed appraiser. Those vary from company to company. Typically, we see those around $3,000. Commercial real estate appraisal. If you're buying or refinancing commercial real estate, you're going to have that commercial real estate appraised. And I've been seeing bids from the appraisers that we use, anywhere from, general use type property, $3,500. If you're financing a single use property like a gas station, right? $4,900 to $5,000 is typically what we see. And if you're doing a ground up construction and they've got to factor in, a lot more to that valuation, you could see that up and above $5,000. But typically, this is the range that we generally see commercial real estate appraisals come in. If we're taking a home as collateral, depending upon the area that we're at, we actually just yesterday had a appraisal that was bid down in San Diego for a home that was like $350, which was shocking because we've seen.
Wow.
But I also think that a lot of that has to do with appraisers not being really busy with residential refinances and purchases right now. So maybe but most of the stuff that we've been seeing up in the last couple months has probably been around that, $500 to $700 for a single family residence appraisal. So, and then environmentals, TSA, which stands for Transactional Screening Assessment, right? Anytime we're taking a commercial property as collateral, we have to have an environmental report done. And those were, I just actually engaged 3 yesterday, and they were around, we did a phase 1, which was $1,200, I think is what they quoted. And then, or a TSA, $1,200, and the phase 1 was right around $2,200. So it's typically what we see on environmentals. And then you've got, stuff that we really have a hard time budgeting for, title and escrow, dependent upon if we're taking commercial real estate as collateral, and getting title insurance on that, taking a residential property or 2 as collateral. Obviously the fees go up and depend upon what the escrow company charges. It varies from company to company, county to county, and then other fees, recording fees, transfer fees, stuff like that. So what do we as a bank typically ask for when we're looking at a deal, right? And it's generally 3 years personal tax returns, federal tax returns from the borrower, right? And a lot of people in California right now have 2022 still on extension. So, but generally we get the last 3 years personal tax returns, and then business tax returns on the business that you're buying, right? And then also if you have an affiliate business and you own other businesses and we have to analyze those affiliates, we'll get tax returns for the last 3 years on those affiliates as well. Historical P&Ls and balance sheets, right? So if we get 3 years tax returns on the business that you're buying, and then we're here in July 2023, we'll ask for, an interim profit and loss and balance sheet, probably within, I don't know, April, May, June, for the, 4, 5, 6 months ending, so we can analyze it within 90 days of the application date. For business that have accounts receivables and accounts payables, we'll also want to see AP, AR with current aging as well. as I mentioned earlier, financials on any other affiliate business that you own and operate. It's a purchase, obviously a copy of the purchase agreement. If we're operating from a lease location, we want to see a copy of the lease, right, to see the remaining terms on the lease. Sometimes a new lease will be getting negotiated, but it's a starting point for us. So qualifying prospects. So you guys are all brokers and agents, right? What to look for? Because I get a lot of deals up front to where it's either, hey, Kelly, I've got a borrower that wants to buy this business, right? Here's their phone number, go get them and qualify them, right? And sometimes I'll have a broker that'll send me a whole entire package on a guy that gal that they've pre-qualified. And sometimes we get, packages on people that, don't have the equity injection, don't have the liquidity, don't have the experience. So as a broker from a lender's perspective, what should you guys look for, right? And it boils down to, hey, does the borrower have the capacity to borrow, right? Do they have the down payment, the required down payment, the net worth, liquidity? We've talked about all of these factors, right? Do they have experience in the industry, right? These are all factors that we spoke about earlier, right? And so, back in my residential lending days, right, and when I was doing residential real estate as a broker, when somebody would come make an offer on a home, you'd say, perfect, I want to see proof of equity injection. I want to see a copy of your credit report. I want to see a pre-qualification letter from a bank saying that you're pre-qualified before I accept this offer, right? And a lot of times in business acquisitions and commercial real estate, you don't see that. They get into contract and then they go to a bank, right? It's not always the case, but it happens sometimes. And then the bank starts all the pre-qualification stuff, right? So, sometimes that creates a waste of time, right? If you get into contract, you type a property, you type a business, you get to the lender and the lender's looking at this and saying, hey, it doesn't have the down payment, doesn't have experience, right? And their credit sucks. Declined. We just wasted everybody's time, right? So these are kind of the things that maybe ask up front or maybe collect up front as you're looking at a deal, right? Obviously the down payment's the key, but all these other factors make a lot of sense as well.
So since this topic today is close more deals using SBA financing, how can we really collaborate and pre-qual those things? So should we gather all those documents and kind of look at them ourselves? Or
that's a good question. And probably, even though I had that slide up, the short answer is probably not, right? Because is a borrower willing to provide all of that up front, to a broker, and that I don't know. Keep in mind, I see it from my side, from the lending side, right? Not from the business brokerage side.
Right.
But if you're talking to somebody, those are good questions to ask, right? I mean, let me go back to the slide just real quick, right? Somebody calls and you've got a business listing. Do you have experience in the industry, right? Talk to me about your experience real quick. And maybe do a quick pre-flight. Hey, so typically, minimum down payments 10 or 15%. Do you have that? How much cash are you looking to invest into this project? What do you have? Where's the money coming from? Maybe not evidence it so much as it is kind of have that conversation to determine if it's somebody that, is worth getting into contract on. I mean, even better, before you do that, give Kelly a call, right? Let me go through and let me pre-qualify. And a lot of times that's what we do. We up front, I get business brokers that call me and say, hey, I've got this listing, get ready to take it to the market, right? I want you to take a peek at it. Tell me if it's an SBA deal. Tell me what you think that you can lend on this thing with the right borrower. And I'll go through and I'll do a full financial analysis on that business, right? Make sure it hits all the metrics that we're looking for and say, hey, this business is pre-qualified. We'll issue a pre-qualification letter, right? And so that they could advertise that it's been pre-qualified by an SBA lender. Now they're just waiting for a qualified buyer to walk through the door, right? So when a potential buyer calls and says, hey, listen, I'm interested in this business. I see it's already been pre-qualified. They'll say, hey, okay, cool. Well, why don't you do this? Why don't you go get pre-qualified as well through our lender, through Kelly, through another bank, right? Before we get and accept your offer. And I love that. I mean, that happens a lot, right? So we get to be early on in the transaction, play a part from, marrying the borrower and marrying the business into making the deal work. So.
Well, and that's how we've been working too.
Yep.
And
and we,
one of the things that I personally do now as I'm talking to potential clients is I say, hey, look, here's how this transaction is going to go. And so I like to front load as much of the things that could be problematic in the end. And I just tell the client this. I'm just upfront and I just say, look, I don't want to waste your time. I don't want to waste my time. I don't want to waste the banker's time. They're going to be asking for these things. Do you have them available now? Or how long is it going to take for you to get your house in order?
yep,
And because I have a background as a certified financial planner, I had a tax practice for 12 years. I tell them that and I say, look, so that we can make sure that we can perform on this project, I'd like to review your information, not as a professional analyzing it, but as your real estate broker, as your business broker, so that I can get an idea if I can even take your package to someone. And that weeds out a good 50% of the people that call me because they really aren't qualified.
mm-hmm.
And so I find it really helpful. And then the ones that I feel will be able to go through the qualifying process, then I'll bring you or a different banker, depending on what their specialty is and what you're looking for, where's a good fit, and bring
Yep.
them in to, help with that analysis and pre-qualification to make sure that we'll be able to get it over the finish line.
Yep. Nope. And I think all that makes sense. And I'm blessed where I work a lot with a lot of experienced borrowers or a lot of experienced business brokers, right? And that's majority of where our business comes from, right? Is external referral sources, and a lot of times when we're, maybe you've got a residential real estate agent that's starting to get into business brokerage, right? And so these are some of the questions that I get when presenting to new referral sources or new groups that are new to SBA lending or new to, maybe business acquisition financing. Is it, hey, what should I ask up front, right? And so those are all good things to ask, right, from the borrower's perspective, right?
Yeah, and
So
Graham is putting in the comments that he works with a due diligence firm to pre-qualify his applicants and prospects.
I think that's great, and again, say even better, but if you have a borrower that needs SBA financing, I mean, get them pre-qualified by an SBA lender, right, as early on as possible. That's something that we like doing up front for sure.
So while we're kind of on that subject, Dominic is asking the question in chat, and I think I know what your answer is going to be. Is he saying what are the types of prospects and businesses that are going to be easiest to pre-qualify? And I think that basically what you've been saying throughout this presentation is we're looking for quality people with experience, with financial wherewithal in a business that has cash flow. But I mean, apart from that, I'm finding like medical practices tend to be very easy to work
Mhm.
with compared to, say, auto shops. So are there any certain industry groups or something that you find are easiest for a broker to go after to build their business?
Yeah, any professional practice, like you said, right? Doctors' offices, dentists, I mean, those are great because you've got doctors or dentists buying those typically, right? So the management experience is right away, a factor that's there. And it really just boils down to the quality of the business and the quality of the buyer. I mean, you hit the nail on the head, Chris, right? I mean, I tend to finance a lot of gas stations, right? I love gas station financing. There's some banks out there that won't touch gas stations whatsoever. And that's fine. That's great. That's not their cup of tea. And I get referrals from other lenders and other SBA lenders that, hey, their bank does not want to do gas stations. So, but with any deal, I mean, honestly, and we talked about those 5 factors, right? It doesn't really matter about the type of the industry that it's in, right? We'll finance hotels, gas stations, um, auto facilities. I've got a big one that we're getting ready to close next month. Auto repair, smog shops, restaurants. There's some banks that don't like restaurants. We love them, but we love restaurants that make sense. We love restaurants that have historical tax returns, financials to go off of, right? That have good trending. COVID, yeah, it's a little bit different, right? Everybody kind of suffered in 2020. So we analyze it, but we kind of throw it out, right? And sometimes in those type of transactions, as those businesses are really affected in COVID and now we're coming out of COVID and have positive trends in 21, 22, and 23, what we want to do is go back and look at, hey, what did the pre-COVID numbers look like? So sometimes we'll go back and ask for 2019 to 2018 to look at the trending. Hey, where are they at the trending now compared to where they were before COVID? So because, you've got some industries like, God, a good one right now is um, hobbyist shops, like mountain bike shops, right? Bicycle shops, or COVID, those things took off. Everybody was home. And I probably in the last couple of years, I've seen more mountain bikes sitting on the back of, trucks than I've ever seen before in my life. Now, with that comes a big growth, but we're also seeing a lot of those for sale now, right? Now, are they for sale because the demand's starting to come down because everybody's back out? COVID isn't as big of a thing as it was before to not keep people in their homes. And, so to answer your question, it's just quality business, quality borrowers, right? Positive trending, stable trending is ideal. We don't always get that, but the proof is in the financials, and the proof is in the balance sheet of the borrower. So
Perfect. Thank you for taking time for that.
yeah, no worries, absolutely. And so, kind of complementing the last slide for the borrowers, what to look for in a business. And here you go, Chris. That question, this is perfect timing, right?
Yep.
Businesses, ideally we like to see 3 years tax returns. We don't always get that. I've got a deal that I just submitted to underwriting that they acquired the business, I think it was 2 years ago. 2 years ago, and due to a medical event, they're having to sell, right? Well, we don't have 3 years tax returns. We've got, I think we've got a 2021 tax return, for a partial year. I think it was a couple months of operation. A 2022 tax return, because I asked them, hey, because of the short term of ownership history, we're going to need a full year of tax returns. So they went and filed 22, and then an interim P&L. So this isn't always the case, but this is typically what we like to look for, right? Something that we can verify. SBA requires that if a business has been in business, that we verify those tax returns, right? To make sure that what we can't do is lend just off of P&L. So if there's no tax returns available and they give us P&Ls, right? We can't verify the P&Ls. We need to verify them with the IRS. So historical financials to go off of, tax returns, positive stable trends. We've talked about this, right? Hey, is the business cash flow positive, right? If it doesn't pencil out and it doesn't make sense, we're probably not going to finance it, right? And I threw this last one in here that isn't always the case, but if you can go through and do a rudimentary calculation of what the cash flow looks like, right? Brokers use SDE, seller's discretionary earnings, right? You also hear net operating income, NOI, right? And then you hear EBITDA, earnings before interest, taxes, depreciation, amortization. At the end of the day, they're talking about just basically the same thing, what we call cash flow, right? And it 3 to 4 times lender cash flow is probably a pretty good idea that, hey, the business is priced somewhere in the realm of where a market value would be, right? If it's up and above that, might be an issue. We have to, like I mentioned earlier, we have to go out there and get a third-party business valuation that's got to support the purchase price. And we're going to be maxed out as a lender, as an SBA lender, lending up to that value of that business, right? And sometimes it's 90% of that, 85% of the value of that business. So, sometimes we'll get deals that we'll analyze them, and it's priced at, 7 or 8 times SDE, which is a high multiple. Now, the response to that is, well, that's what the seller wants. Okay, well, you got a business that's priced at $1 million, but I could lend $500,000 on that business because that might be worth $600,000 or $620,000, right? The buyer's going to have to come in with that difference. We're not going to allow the seller to carry that, because at the end of the day, that's going to blow up our cash flow, right? At the end of the day. So yeah, a good rule of thumb, 3 to 4 times SDE, 3 to 4 times lender cash flow. It's probably a good quick and dirty benchmark to look at, is whether a business is priced according to market, I guess, right? Now, again, if you're not getting financing and you got a buyer that's got all cash, none of this pertains, seller can sell for whatever they want to, the buyer can buy for whatever they want to, right? We're just talking in the case of when you got a borrower that needs SBA financing to complete a transaction.
So I'd just like to interject real quick here. When you're dealing with a business that is newer or recently acquired, so like I brought you a business recently that was acquired about a year ago. And so they had a tax return for a partial year of 2022 that they filed, but they've been able to increase cash flow. And, you know, as bankers, you guys usually ask for interim P&Ls and balance sheets. But what I did with this client is I said, hey, look, you're showing cash flow increasing. This here interim P&L, which is a single number for the period year to date, isn't reflecting how that cash flow is increasing. And so what I suggested to them and what they're preparing now is a T12, going back and showing their month to month increase in revenue so that you can track that more readily. And something like that should be very valuable to someone like you, right?
Definitely. So perfect example, right, is seasonal based businesses, right? And example that's coming to my mind because I have one of these going on right now is a pool supply company, chemicals, pool supplies, and all that stuff. Well, when it rains and going, you know, we had our first quarter in California this year was crazy, historical rainfall, right? And when that affects the business, right? If we get an interim P&L, say through March, but January and February had really, really high rain, it's going to show when I annualize that out compared to the prior year, that it's going to look like the business is tanking, right? The annualized revenue is probably going to be down considerably, right? So what we do is exactly what you said. We'll go back and say, hey, get us a comparison from the prior year, same time period, right? And maybe even kind of go back further to look and see what it has been historically, right? And then we can make the assumption, and I have another deal going on right now where the first quarter is generally a slow quarter. And we went back and looked at, and it showed, I think it was off the top of my head, that revenue was down like 24% for the year annualized out in the interim compared to the prior year. And I asked them for, hey, give me a 2022 P&L for the same exact time period. And they're actually up this quarter compared to where they were last year. So
it all balances out in the end.
Absolutely.
Basically.
Yeah. Common sense, right? So,
yep. Okay. So Paul is asking in the chat to talk about lender cash flow. Oh, perfect timing, Paul.
It's like he knew, right?
Yeah.
Let me do this. So, and this is what I'm gonna do. I'm gonna exit out of this presentation. I've prepared a cash flow model, all made up numbers, of course, but I'll run through an example of what it looks like on my end when I get a deal and I enter it into my system, and we'll kind of go through that. So let's go.
And we've got about 15 minutes left. So this may be the last thing we're able to do today, depending on how long it takes to go through it.
Gotcha. Okay. Share screen.
So while we're waiting for Kelly to pull that up, if you guys have enjoyed the presentation today, we'd invite you to put some notes in the chat and let us know what you like best and what kind of things would you like us to talk about in the future on our commercial real estate business brokerage series that we're working on. And it could be Kelly that comes back, or it could be other guests. So let us know who you'd like to hear from and what other topics.
All right. Can you see my
Yep.
screen now? Okay, perfect. So here's an example that I created, right?
And this is the internal documents that you're using to analyze the projects for the bank, correct?
Really close. I tweaked them a little bit for this presentation, but this is essentially what very, very similar to what we use, right? So this one is an acquisition of an existing restaurant operating from a leased location, no commercial real estate, right? Name of the restaurant or the borrowing entity is Best Restaurant Ever LLC, doing business as American Comfort Food. The buyer is 100% gentleman by the name of John A. Pruble. Okay. So this first one is our use of proceeds, right? So we've got a business acquisition here for $260,000. Down payment 15% of the total project costs, right? Including costs and fees. And I'm dumping in a little bit of working capital for Mr. Pruble here, right? So this is typically a structure that we see. Let's just say $247,000 loan. 8.75% roughly, fixed 10 years, fully amortized over 10 years. Okay, monthly payment, as we calculated earlier, it kind of shows you earlier in the presentation here, the SBA fee is nothing because it's $500,000 or below. Estimated loan costs, not a whole lot here because it's under 250. I don't need a business valuation. We're just kind of throwing, here's the bank's packaging fee, which consists of $1,350 and then a site visit to get our $1,500 fee. And then all third-party costs, title, escrow, all estimated because I never know exactly what those are, right? Because it varies from company to company.
So
Our
just real
collateral-
quick,
Yeah,
when dealing, a lot of people have background in residential real estate that are joining us probably, and they're used to getting what they call the fair lending statements or whatever they are, where it gives all the estimated costs. Do you do the same thing on the commercial side?
yeah, no, it's because they're not required on commercial or small business. So they give probably what's called a GFE or truth in lending statement, right? Too.
Right.
So what we end up doing is basically exactly. So I've got a pre-qualification letter that I do, and we could come top if we've got. I know we got 15 minutes left. I got a bunch more slides to get into underwriting and what we look for in the process. But we issue a pre-qualification letter up front that discloses all the estimated fees, right? And we typically budget pretty closely. But we don't budget for third-party fees because we never know, right? Exactly what they are, except for that escrow, environmental, third-party fees that we order for the reports, but title and escrow, it's just so hard to do. We leave that up to the escrow companies. So,
All right, thanks for that little tangent.
yep. And then here's our collateral, right? So all I've got here, because we're financing basically a cash flow stream, $2,500 in inventory. Not worth a whole heck of a lot from a collateral perspective. Collateralization is 0.1%. Unsecured exposure, $246,000 on a $247,000 loan, right? So this is the cash flow analysis and where we kind of analyze the tax returns and historical operations of the business, right? So up here, right, we've got revenue, cost of goods sold, gross profit. What I look at is obviously the trending on revenue. This is the annualized revenue growth, positive. Revenue trending positive. All these ratios are pretty darn close. A little bit of variation and deviation, but all in all, pretty close. Kind of coming down here to analyzing the expenses. Nothing seems out of whack to me. Everything seems to be a very well operated business with all the expenses in line. Okay, so this is where we get back to our add back. So we've got our net income here on the tax returns, right? My add backs, officer's compensation with existing owners paying himself or herself, and then interest expense. And I don't have much more, right? So this number, which I'll show you on another spreadsheet here in a second, is what this borrower needs to live off of based upon pulling his credit and calculating a 45% debt to income ratio. Okay, $82,700. This is our annual loan payment. And this is what we talked about earlier. This is our debt service coverage ratio. So again, as I mentioned, a debt service coverage ratio of 1.2 and above is typically what we like to, typically what we like to see. And in this case, I don't have that in 2020. Talk it up to COVID, maybe. It is a restaurant.
Yep.
I don't have that. I'm just basically above break even in 2021. But I'm healthy in 2022, above policy, and the interim at 1.8 is above policy as well. So this is decent cash flow, debt service coverage ratio in the last two periods that we've analyzed. I also do a balance sheet analysis, right? And this is where we kind of come down here and calculate, here's the debt to net worth, which is something that we really pay attention to, 5.7. Okay. We analyze the borrower's personal balance sheet, right? Their personal financial statement. So John's got $90,000 in cash, $15,000 in retirement, right? With his down payment, his post-acquisition liquidity is $66,000. It is a restaurant, cash-based business. Pulled his credit, and this is what he has, right? This is all in thousands. So got some installment debt, got some student loans. Credit score 686, below 700. And the reason for that, he's got a medical collection, okay? This is where we calculate his personal draw. So, and kind of going back here, I've got a note here is that borrower sold his home. Recently, that's where he came up with his down payment. So he doesn't have a home, doesn't have anything that we could collateralize. Okay.
Mm-hmm.
This is where we calculate his personal draw calculation. right? So living expenses, he doesn't own a home. He says his rent's $2,000 a month. His student loan is actually from a culinary academy, okay, for culinary school. Good. He's buying a restaurant. This is how we calculate our credit card debt. We take the minimum, or take the balance that he has, times it by 5% and kind of come up with the monthly payment there. So looking at all the debts that he has and accounting for a 45% debt to income ratio, this is what he needs to earn on a gross basis, that what we say he needs to live off of. Now he's buying this business, he's going to operate it full time. He doesn't have any outside income. So this is what needs to be drawn from the business. Okay. So there's a note that I missed back here. Fire alarm test is going off. Sorry, guys. There's some experience on John, right? Is that John has over 7 years management experience at a local all-American style restaurant with a focus on comfort food. Additionally, he has worked an assistant manager for 2 years at a nationally branded full-service restaurant chain. So as we kind of come here and look at the 5 factors that we spoke about earlier in the presentation, here's what we kind of present to our senior committee when we try to present for an approval, right? He's got 2 years management experience. Repayment ability, I've got 2 to 3 years of debt service coverage ratio above policy. We were both above 1.2 in the prior years. We don't have any collateral, right? And we know that John has that medical collection, so he's got 1 ding with an acceptable explanation. Our down payment is 15%. Yeah, this is a minimum of 10% down, pro forma debt to net, or pro forma debt to net worth of 5.1. We exceed that 5.1 ratio, but we've got a 15% down payment. So at the end of the day, we've got an acceptable credit here. We've got a fair score based upon these credit factors, right? And so, you know, and the last thing that I do here is we've got these kind of business valuation estimates, and I do 2 of them. This is a return on investment analysis that kind of calculates, basically, I called it lender cash flow earlier, right? But basically looking at what the adjusted earnings are with our add backs, what John needs to live off of, right? And kind of waiting these years to kind of determine what is the adjusted earnings of this business, right? And typically we look at, for most businesses, around a 20% ROI. A restaurant might be a little bit closer to 25% because they typically have lower multiples. But at the end of the day, I'm coming up with an ROI business evaluation estimate based upon an ROI of 20%, or right around where the purchase price is, 262, right? This is another analysis we do, and I won't get too deep into this thing, but a discounted future earnings comes up with a valuation, you know, around the purchase price. So at the end of the day, we don't have any collateral. We've got acceptable cash flow in the prior 2 periods, and ultimately a deal that we would approve. So this is a good example of what we do every single day and how we analyze a deal and kind of go through it.
That's really helpful. And before today, I actually have never seen this. You know, none of the bankers I've been dealing with have taken the time to show this to me. So thank you for doing that.
You're very welcome. Let me go ahead and stop sharing here. Let me get back.
And while you're doing that,
how are we good on time, Chris?
like 5 minutes left.
Okay,
so,
cool.
But Graham is given a great chat expressing his appreciation for today's program and for you.
Oh, good. Well, since we got 5 minutes left, do we want to pause from here? I mean, I could get into some multi-use properties, different property types and all that stuff.
You know,
but,
I think that we should just pause right here. And I think we've done a really good job. And maybe does someone have a question that they want to ask in just the last minute or 2 before we sign off for today?
I'm gonna go ahead and stop sharing here, Chris.
Yep.
Go.
So, but this has been really, really interesting today. I've learned new things, and you know, the people have been sending me some text messages and chat messages. Everything has been very positive. So thank you very much for joining us.
Yeah, you're welcome.
And Jose Estrada is like, thanks for the transparency.
You're welcome. Hey, that's what we do. I mean, at the end of the day, the goal is to, you know, figure out a way to make the deal work. right? The metrics have to make sense, but what we do is it's common sense SBA lending, right? If there's a way to make the deal work, we try to do everything possibly that we can, right? But hopefully we do a part 3. I've got a bunch more good stuff I can share. I could go deeper into underwriting and how the process works, start to finish, time frame that it takes, and all the steps that we do behind the scenes, that might help you have a better understanding of how the whole program works. So
Yeah. And for those of you who are joining us live, it'll probably take me a week or so before I'm able to edit and put it up on YouTube. And so if you register for this using the link that I provided, then you're on my mailing list and you'll get an email when we post the videos.
yeah,
And we're also planning to post videos. I've been wanting to get this out for like 2 weeks, but it's coming, I promise. It's demystifying environmental services in commercial real estate and business brokerage.
hey, Chris, I see in the chat, Dominique's got a question. I could pop and answer that one just real quick. I mean, honestly, a great one for a realtor, property management company, right? I mean, that's experience in the industry, and we've financed a couple property management companies for real estate agents. So if that's something that interests you, and I mean, we'd love to take a look at a deal.
Yeah, and property management is something that my partner and I actually specialize in. And so if you're looking for a property management company, please let me know. And if you are looking for financing, please talk to me. I'll pre-flight you before I refer you over to Kelly. And if Kelly's not the right partner, then we'll find another partner for you. All right. Well, hey, Kelly, awesome. You've been fantastic as always. I really love your presentation style and the way that you really are transparent and you're giving us insights that I actually haven't heard from other people. So thank you very much for that.
Awesome. You're welcome. Very welcome. Looking forward to part 3. Hopefully we do it soon.
Awesome. All right. Thanks. We'll see you soon.
Thank you, everybody.
Appreciate everyone coming in today.